Today, we are looking at a really fascinating company, Nebius Group, NV, ticker NBIS.
Hmm?
And this isn't just any tech company. This is, a pure play bet on the whole AI infrastructural boom. And boy, does it come with some extreme volatility.
Oh, absolutely. The documents you shared, the Q3 2025 earnings call,
Hmm.
the analyst reports, they paint a picture of, well, extraordinary growth, but also massive, almost existential capital risk.
Right.
The backstory here is just so dramatic. I mean, NBIS stock was up over 200% this year,
An incredible run.
and then it just dropped, what, 33% from its high in October? A painful drop.
And that whiplash, it
Yeah.
really tells you just how confused the market is. So our mission today is to cut through some of that noise.
Mm-hmm.
We're going to break down the core investment thesis, the bull case, and then we'll get into the big risks, the execution, the capital crunch.
Bear argument.
Exactly, the bear argument. And then finally, we'll lay out the valuation references that are actually moving the stock. I think by the end, you'll really get why this company is playing one of the highest stakes games out there right now.
Okay, so let's jump into that bull case, right? Because it's a heck of a story about transformation and just pure velocity.
It really is.
Nebius had this huge corporate pivot. Most people know it was spun out of Yandex, which was often called the Russian Google.
Right.
And after they sold off their Russian assets in 2024, they aggressively repositioned the whole company in Amsterdam to focus purely on international AI infrastructure.
And that pivot, it wasn't just moving offices. It was a fundamental shift into a completely new hyper-growth market. And
Yeah.
the Q3 2025 numbers show they just floored it.
They really did. Total revenue surged 355% year over year to $146.1 million.
Wow.
But what's even more compelling, I think, is the makeup of that growth.
Okay.
Their core infrastructure business, so the actual GPU cloud services they sell, that part grew 400% year over year.
So even faster than the headline number, why is that difference so critical?
Well, it tells us that the most important part of their business, the part with the highest potential margin, is accelerating even faster than the rest of it.
So it's both explosive market demand and proof that their strategic pivot is working.
Exactly. The market is giving them credit for the execution. And you really see that in their annualized run rate, the ARR.
Mm-hmm.
They closed Q3 with $551 million in ARR for that core business.
Yes.
It's a 73% increase quarter over quarter.
73%. That's a pace that's just, it's almost hard to comprehend.
It is. It's phenomenal to see.
And all that velocity seems to be anchored by these huge contracts, which gives them some pretty staggering revenue visibility. This isn't just selling cloud space month to month.
No, not at all. We're
Right.
talking massive multi-year agreements. The big one, of course, the one everyone talks about, is that Microsoft deal from September.
The gigantic one.
Yeah, valued between, what, $17.4 billion and $19.4 billion through 2031?
That one deal just changed the entire scale of the company overnight.
It did. And then just 2 months later, they land another one, the Meta deal.
Right. About $3 billion over 5 years.
So when you hear management talk about their conviction, I mean, they're not just speculating. The CEO kept saying they are in the center of a once-in-a-generation AI revolution.
And that conviction, it leads to some really ambitious guidance that, makes that bull case so compelling. They're targeting an annualized run rate of $7 to $9 billion by the end of 2026.
The scale of those numbers is just, it's unbelievable. But here's the kicker, the thing that really validates it.
Okay.
Management said that more than half of that $7 to $9 billion target for 2026 is already booked.
Already booked.
Already booked through these long-term contracts. That visibility is, I think, the single strongest argument the bulls have. They aren't just selling a promise, they're selling committed revenue.
That's incredible. But okay, that kind of demand leads us right into the biggest problem, doesn't it?
It does.
If they have all these guaranteed sales, why isn't the stock even higher? And the answer has to be the execution bottleneck.
Exactly. According to their own transcripts, capacity is the main bottleneck to revenue growth.
Mm-hmm.
They are, and this is their own words, fully sold out.
They literally can't meet the demand they've already secured.
Right. It creates this huge operational challenge.
It's the ultimate good problem to have, I guess. I saw that anecdote from the go-to-market executive about learning how to say no to customers.
Yeah, that was very telling.
They generated $4 billion in pipeline in Q3 alone, a 70% jump quarter over quarter, but they just didn't have the capacity to convert most of it.
And this isn't just a bottleneck, it's a race against time. If Nebius can't build out fast enough, The big hyperscalers will be happy to step in and take those customers.
So the only solution is just a massive, immediate fire hose of capital expenditure.
A fire hose is a good way to put it. Massive feels like an understatement here. They raised their CapEx guidance for 2025 from $2 billion up to about $5 billion.
Wow.
They're just securing infrastructure as fast as they possibly can. It shows total conviction in that demand.
Okay, but let's put that $5 billion CapEx number in perspective. At the end of Q2, they had, what, $4.8 billion in cash? So they are basically committing their entire cash pile just for the rest of this one fiscal year. This isn't growth at all costs. This is like survival at all costs.
It is. It's an all-in bet on the future.
So where's that money actually going? The infrastructure exec broke down their model, which I thought was one of the most interesting parts of the reports.
Oh, yeah, that was fascinating. It really shows you the new economics of this AI arms race.
Right. So stage one, land and power, is surprisingly cheap, like 1% of the total cost.
Just 1%. And the building itself, the data center, is only about 18 to 20%.
Which leaves the other 80% almost entirely for the chips, for the GPUs and the networking gear.
Exactly. The new reality is that building an AI cloud is less about real estate and more about securing your place in the chip supply chain.
And the scale of this is just staggering. They raised their contracted power target from 1 gigawatt to over 2.5 gigawatts by the end of 2026.
And their connected power target, so data centers actually online and running, is 800 megawatts to a full gigawatt by the end of 2026.
So while they're focused on raw power, they're also innovating on the product side to protect their margins. We saw them launch Aether 3.0, and maybe more importantly, the NBIS token factory.
The token factory is, I think, a brilliant strategic move.
Why so brilliant?
Because management knows the next big wave isn't just training these huge foundational models, it's applying them. It's inference as a service for all kinds of different industries.
So they're moving up the value stack. They don't want to just be a simple compute provider. How does that help with profitability?
Well, the token factory changes the conversation from, how many server hours did you rent, to a very transparent cost per token model. It lets them compete on efficiency. They're betting their specialized, vertically integrated stack can deliver better performance and lower costs for these AI inference jobs than the big generalist cloud providers can.
And that focus on efficiency seems to line up perfectly with what the CEO said. He said they're very much focused on margins and profitability, not only on growth itself.
Yes, they want those high margins, even on the mega deals.
But that priority, that need for high margins, that leads us right into the bear case, doesn't it? The whole funding dilemma.
It does. This entire growth engine, it runs on capital. And the amount of debt they're going to need is, well, it's dizzying.
So let's look at that balance sheet again. End of Q2, $4.8 billion in cash, but also $4.6 billion in total debt. Pretty much a wash. Now, layer on the capital they need to actually hit those 2026 targets.
Right. Analysts estimate that building a single 1 gigawatt data center, which is what they're aiming for, costs somewhere between $30 and $40 billion.
Or 30 to 40 billion.
Yeah, when you factor in the building and all the chips to fill it up, it puts their $4.8 billion in cash into a pretty terrifying perspective.
It's a rounding error compared to what they need to raise.
It really is.
So how are they going to finance this? The plan seems to have three parts: corporate debt, asset-backed financing, and equity.
Right. They did that convertible note offering in September, which brought in a good chunk of change.
But for shareholders, the equity part is the scary one. They're setting up an at-the-market or ATM program for up to 25 million shares.
Which gives them quick access to capital. And while management keeps saying they're dilution sensitive,
It's a little hard to square being dilution sensitive with needing tens of billions of dollars,
it is. How long can they really go without significant shareholder dilution? Increased interest expenses and dilution, those have hit the stock hard before.
And this capital crunch creates the wild valuation swings that make NBIS so volatile. If you look backwards at their trailing 12 months, the price-to-sales ratio is, what, 60 or 64x?
Something like that, yeah.
Yeah.
Which is incredibly high. The NASDAQ is around 5.5x. It just signals that the stock is priced for absolute perfection.
But the market isn't valuing last year, right? It's valuing what they're promising for next year.
That's the counterargument, exactly.
Yeah.
If NBIS actually hits that 7 to 9 billion ARR target in 2026, then the forward price-to-sales ratio collapses to around 3.7x.
So that's the whole story right there. 60x versus 3.7x.
It's the entire investment thesis in two numbers. The market is betting they can pull it all off, Raise the capital, build the data centers, hit the target with zero mistakes.
And the fact that the stock is trading at less than 1.5 times its contracted backlog of over $20 billion, I guess that provides the floor for that optimism.
It helps.
Okay, so beyond the financials, there are also the practical risks the execs themselves mentioned. Things like supply chain constraints, more competition, the macroeconomy.
And we have to talk about concentration risks.
Oh, for sure.
Their success right now is so heavily tied to that one huge Microsoft contract. If anything were to happen to that deal, a cancellation, renegotiation, it would be devastating for the stock.
And then there's the big existential question looming over everything, the AI bubble.
Right. Management seems to think that even if there's a bubble, their focus on building a cloud for real businesses with things like the token factory will insulate them from the worst of it.
Okay, so after weighing all of that, the infinite demand against the very finite capital,
Well,
where does Wall Street actually stand on this thing right now?
well, the analyst consensus is still pretty optimistic. It's holding at a moderate buy.
And the price targets reflect that confidence, right? The average target is somewhere around $142 to $154 a share. That's a potential upside of over 50% from where it's been trading.
It is, but you have to look at the huge range in those forecasts. The low is around $111, the high is all the way up at $221.
That range really captures the uncertainty, doesn't it?
It perfectly encapsulates the huge execution risk we've been talking about.
But even with that risk, it seems like the big money is moving in. We saw a 34% increase in institutional owners last quarter.
660 funds reported positions, and the derivatives market is also looking bullish. The put-to-call ratio is down at 0.66. It seems like the big players are betting they can pull this off.
So to synthesize all this, NBIS Group is in this massive high-stakes race where demand is nearly limitless, but the things you need to meet it, capital, power, chips, are the choke points.
Yeah, their long-term survival depends entirely on how fast they can execute and how well they can manage the cost of this gigantic build-out.
Which leaves us with a final provocative thought for you to think about. The CEO says he's prioritizing high margins over just raw growth. So will their vertically integrated strategy, which requires raising billions and billions of dollars, actually deliver superior, sustainable profits compared to the big hyperscalers? Or will the crushing weight of all that capex force so much dilution that it erodes those margins before they ever get off the ground?
It's the ultimate test of operational efficiency meeting financial leverage.
A truly fascinating situation to watch.
Continue to watch for our next release.